It feels like everyone is chasing the next massive tech startup these days, like hoping to strike gold in artificial intelligence or software.
Oh, absolutely. It's all about the glamour stuff.
Right. But what if I told you that one of the most lucrative, like scalable wealth building engines in America right now is actually painting fences and cleaning gutters?
I mean, it sounds completely unsexy,
It
don't it?
really does. But when you inject Silicon Valley level corporate infrastructure and data-driven unit economics into the traditionally, fragmented home service industry, the financial models just get wild.
They really do. The math completely changes.
Exactly. So today's deep dive is on exactly that. We are unpacking the mechanics, the financial footprint, and the underlying buyer psychology behind a rapidly emerging franchise model called Groovy Hues.
Yeah, and it's a fascinating one.
It is. We're looking at how a seemingly simple service business is engineered for multi-unit growth and semi-absentee ownership. So let's just get right into it.
That framing hits on a major shift in modern investment strategy, I think. Evaluating a franchise opportunity in this space, like home and commercial services, it requires looking past the physical service itself.
Right, like looking past the actual paint going on the wall.
Precisely. The real focus has to be on the engine running quietly behind the scenes. We are analyzing a highly deliberate system built specifically for the investor class, not just your traditional owner-operator who, wants to climb a ladder with a brush in hand.
Yeah, that makes total sense. So to understand the investor's potential return, we first have to dissect why the end consumer is choosing this business over the thousands of local competitors, right? Because consumer demand dictates the unit economics.
100%. It all starts with the buyer.
Okay, let's unpack this. If we look at the Groovy Hues service matrix, it is massive. They handle interior and exterior painting, both commercial and residential.
Which is standard enough, but then they go further.
Right. They layer on this whole suite of ancillary services: cabinet painting, deck staining, fence treatments, power washing, and gutter services.
And that breadth of services is a highly calculated structural choice. It heavily impacts the customer lifetime value, or LTV,
Huh.
down the road. But, the service itself isn't the primary differentiator.
It's the acquisition strategy, isn't it?
Exactly. The acquisition strategy is where the magic happens.
Well, their consumer-facing features seem specifically designed to elevate what is usually a grueling process. They lead with professional color consultations, interactive visualization tools.
Which is huge, by the way.
Yeah, so the homeowner can see a digital mock-up of the finished space before any work begins. And they use premium paints, and they even do on-the-spot custom financing.
Right, which completely changes the game.
Contrast that with the traditional industry norm. Like, you call a number off a flyer you found taped to a stop sign, you pray the guy in a truck actually shows up.
If he even calls you back.
Exactly. And then you end up living in a half-painted living room surrounded by drop cloths for 3 weeks. This approach feels like the difference between hiring a flaky freelance designer versus a full-scale, accountable creative agency.
That is a perfect analogy.
But I do have a fundamental question about the execution here. Do things like interactive visualizers and custom financing actually reduce consumer friction, or do they just add unnecessary steps to buying a paint job?
What's fascinating here is that you have to look at the psychology of the homeowner to answer that.
Yeah.
Consumers aren't actually buying paint.
Wait, what do you mean? What are they buying?
They are buying certainty. They are purchasing the assurance of a stress-free project, backed by clear communication from the first touch point to the final walkthrough.
Oh, I see.
Yeah, so when you introduce an interactive visualizer,
Yeah.
you are attacking the largest psychological hurdle in home renovation, the paralyzing anxiety of buyer's remorse.
Oh, man. Yeah, because nobody wants to spend $10,000 to realize they hate the color covering their entire house.
Exactly. It mitigates the risk before a single dollar changes hands, and that builds immediate tangible trust.
Right. And then I guess you pair that trust with the on-the-spot financing.
Which fundamentally alters the sales dynamic right there at the kitchen table.
Yeah.
In home improvement, the single biggest barrier to a closed deal is the immediate out-of-pocket capital requirement.
The sticker shock.
Yes, by offering transparent payment plans natively, the franchise removes that barrier completely.
But I wonder, does introducing credit checks and interest rates at the kitchen table make the sales pitch feel a bit too aggressive? Or maybe overly corporate for a local home service.
You'd think so, but it actually has the opposite effect when it's presented as an optional tool for flexibility.
Really? How so?
Well, when a consumer realizes that grouping the exterior painting, the deck staining, and the power washing into one project turns a daunting $15,000 lump sum into a manageable, say, $250 monthly payment.
Oh, wow. The conversation totally shifts.
Exactly. It shifts from what can I afford today
Hmm.
to what does my home actually need.
That makes a lot of sense.
This specific mechanic drives significantly higher average ticket sizes for the franchise owner, all while making the customer feel empowered rather than financially drained.
So the consumer feels they are getting this premium, highly professional experience, and the franchise owner gets a larger initial contract.
It's a win-win.
But promising a seamless, top-tier experience across dozens of states requires intense operational consistency. Like that logically requires a massive support system, which leads us right into the institutional engine backing the local franchisee.
Yeah, the corporate infrastructure is where this model transitions from a typical small business into a true enterprise-grade asset.
Here's where it gets really interesting. Let's look at the numbers behind that infrastructure because the data gets genuinely shocking here.
Lay it out.
So, Groovy Hues has been a franchise since 2020, and they are backed by established industry leaders, horsepower brands. But here is the statistic that stands out. Their headquarters employs 250 people.
Yeah.
250 corporate employees. Meanwhile, they only have about 11 units currently in operation.
It's quite the ratio.
It's wild. Having 250 corporate staff members for just 11 open units is like buying a massive enterprise-grade server farm just to host a single local bakery website.
It's a good way to put it.
It implies they are anticipating and have pre-built the foundation for massive, rapid scale. But as an analyst, how do you interpret that disproportionate ratio?
If we connect this to the bigger picture, that ratio tells a very specific story about who they want to attract as franchise owners.
Okay, who are they looking for?
They are not looking for a painter who wants to be their own boss. They are targeting corporate professionals looking to transition out of high-stress executive roles,
Right.
or semi-absentee investors wanting to diversify their capital into cash-flowing assets.
Right, the people who don't want to be wearing overalls.
Exactly. Those demographics do not want to build an operational backend from scratch. They are looking to acquire a fully functional business operating system.
So those 250 employees are essentially the prepackaged operating system.
Yes, exactly.
But what are they actually doing day to day to justify that headcount?
They are managing the heavy lifting that usually suffocates independent small business owners. We're talking about dedicated teams running national and localized digital marketing.
Oh, wow.
Yeah, SEO optimization, inbound lead generation, customer management systems, and vendor pricing negotiations.
That is a lot of back office support.
It is a profound shift in daily responsibilities for the franchisee. Instead of waking up at 2 a.m. to fumble through Facebook Ad Manager or reconcile QuickBooks, the owner is shielded from the administrative weeds.
Right, they can just focus on running the business.
Exactly. They focus exclusively on executive functions, managing their sales team, optimizing their local crews, and building high-level community relationships.
So it allows the owner to actually act as a CEO, rather than an underpaid chief marketing officer, IT director, and HR manager all rolled into one.
That centralized support is the safety net that makes semi-absentee ownership viable. You can maintain your primary corporate career or manage other investments because you are leveraging a massive enterprise-level back office to run the localized home service brand.
Okay, but if the corporate team is doing all that heavy lifting, they certainly aren't doing it for free.
Definitely not.
And that brings a massive cost-benefit analysis to the potential franchisee's doorstep. So what does this all mean? Let's dig into the actual unit economics and the financial footprint required to access this 250-person machine.
The parameters are very specific.
Right. The initial investment range sits between $223,000 and $420,000. And to even qualify, an aspiring buyer must demonstrate a minimum net worth of $500,000.
And possess $100,000 in liquid cash.
Yes, exactly. And the franchise agreement operates on a 10-year renewable term, carrying an 8.5% royalty fee.
Those figures establish a clear barrier to entry. And they set the expectations for the financial runway needed to launch successfully.
Well, the 223,000 to 420,000 range makes structural sense. It's a strategic middle ground, right?
It is.
Like it filters out people without serious capital, but it avoids the multi-million-dollar outlays required for physical brick-and-mortar assets, like a fast food drive-through or a boutique fitness studio where you're just pouring cash into commercial real estate before a single customer even walks through the door.
Yeah, you avoid all that real estate overhead entirely.
But I need to push back hard on that operational cost. Let's talk about the 8.5% royalty fee.
I knew he'd get here.
I mean, any seasoned investor hears 8.5% of gross revenue, and their alarm bells immediately go off. In a service business where you have hard costs, like buying premium paint, maintaining vehicles, and paying local labor, an 8.5% slice of the gross could easily wipe out a massive chunk of your net profit.
Right.
So how does the franchisee not go broke paying that kind of premium to headquarters?
This raises an important question, and it is the exact friction point every sophisticated buyer wrestles with when reviewing a franchise disclosure document.
That just sounds so steep.
The instinct is to view the royalty as a pure brand tax, just a fee you pay to put their logo on your trucks. But in this specific model, you have to run the math on the replacement value of that fee.
The replacement value?
Yes. That 8.5% is the direct cost of outsourcing to the 250-person support structure we just talked about.
Oh. Okay, so let's run a hypothetical scenario here. If a franchisee generates $1 million in gross revenue, they are sending $85,000 back to corporate. What are they actually getting for that 85 grand that they couldn't just build themselves?
Well, if you are an independent operator doing $1 million in revenue, try hiring a full-time seasoned marketing director,
Right.
plus a dedicated SEO agency, an IT specialist to manage your interactive visualization software, and a fully staffed customer service call center to answer inquiries while your crews are on the ladders.
Yeah, that's impossible.
You cannot assemble that team for $85,000 a year. You'd be looking at hundreds of thousands of dollars in salaries, benefits, and software subscriptions alone. That overhead would completely devour your net profit.
Wow, okay. When you frame it as payroll replacement, the 8.5% suddenly looks like a highly discounted fractional executive team.
That is the definition of operational leverage. By paying the royalty, the local owner maintains an incredibly lean local footprint.
Like just themselves and a couple people.
Perhaps just themselves, a sales estimator, and their contracted painting crews. They avoid the fixed overhead of a massive internal staff, converting what would be fixed payroll costs into a variable cost that scales perfectly with their revenue.
That makes total sense. It's an economy of scale that independent contractors simply cannot access.
Exactly.
That explains the operational efficiency. But let's look at the launch requirements for a second. Why the strict demand for a $500,000 net worth and $100,000 in liquid cash if the initial investment caps out at around $420,000?
Basically comes down to business survival mechanics. The initial investment covers the tangible setup, like vehicles,
Equipment, all that stuff?
right, equipment, initial marketing blitzes, and franchise fees. The net worth and liquidity requirements ensure the owner has the personal financial stability to weather the ramp-up period.
Because it takes time to get the engine running.
Exactly. It takes time for the marketing engine to generate leads, for crews to complete the work, and for cash flow to actually stabilize. A well-capitalized owner can focus on executing the growth strategy without panicking over month 2 cash flow constraints.
Okay, so the franchisee is well capitalized, they launched the territory, and they are utilizing the corporate infrastructure to maintain lean local operations.
Yep.
How do they actually maximize their return on investment over that 10-year term?
That is where the fun begins.
This brings us to the long-term strategy and multi-unit expansion. Because looking at the brand's footprint, there is massive territorial white space available across the country, almost every state from Alabama to Wyoming.
The map is wide open.
And we noted earlier that they don't just paint houses, they do commercial properties, gutters, decks, fences, and power washing. From an economic standpoint, this service matrix looks exactly like the land and expand strategy used by major enterprise software companies.
The software comparison is highly relevant here. Let's map out how that land and expand architecture functions in a localized physical service market.
Well, in the software world, you acquire a corporate client on a basic, low-cost subscription tier. Once they are integrated into your ecosystem and trust your platform, you aggressively upsell them to premium features or you charge them for additional user licenses.
Right, because the hardest part is already done.
Exactly. The underlying logic is that it is exponentially cheaper to sell more products to an existing client than it is to hunt down a brand new one.
And that applies perfectly to Groovy Hues.
Right. So, applied here, you spend the marketing dollars to acquire a homeowner for a standard interior living room paint job. You deploy your crews, you utilize the visualization tech, you provide an entirely frictionless experience, and suddenly you have a locked-in relationship.
You're in.
You are no longer just a painter, you are their trusted home maintenance vendor. So next spring, when their deck looks weathered, or next fall, when their gutters are overflowing, they aren't going back to Google to read reviews for a new contractor.
No, they're calling you.
They are calling you. You landed the initial account, and now you are expanding the revenue over time.
We have to ground that concept in hard financial metrics, though. Specifically, customer acquisition cost, or CAC, and lifetime value, or LTV.
Okay, let's break that down.
In a single service business, let's say a company that only does roof replacements, you pay massive CAC to get a customer, you do the roof, and you likely never see them again.
Right. Nobody buys a new roof every year.
Exactly. The LTV is capped at that one transaction. By maintaining multiple distinct service lines, this model dynamically multiplies the LTV against a static acquisition cost.
Let's run the math on that to make it concrete.
Okay, imagine it costs you $500 in Google Ads and local marketing to acquire a customer for a $2,500 exterior paint job. If that is all you offer, your margins are constantly compressed by the need to continuously spend $500 to find the next customer. But with this model, that same $500 initial ad spend eventually yields the $2,500 paint job, a $1,000 deck staining a year later, and a $500 gutter cleaning the year after that.
Wow.
So you have generated $4,000 in revenue off a single $500 acquisition event. Your CAC stays flat, while your LTV skyrockets.
Because the hardest and most expensive part of the transaction is just getting the homeowner to trust you enough to open their front door that very first time.
Exactly. The cost of subsequent sales to an existing satisfied customer drops to near zero.
That is incredible.
For a multi-unit or semi-absentee investor, this dynamic is the ultimate scaling mechanism. It allows them to aggressively scale their top-line revenues within their existing protected territories, all without having to exponentially increase their digital marketing budget.
And having those diverse service lines must also provide a hedge against seasonal or economic downturns, right?
Yeah.
Like it builds a naturally resilient portfolio.
Oh, it creates a tremendous amount of macroeconomic insulation. A franchise owner is not entirely reliant on a booming housing market.
That's a huge relief for investors.
Definitely. If interest rates spike and new home purchases slow down, people are far more likely to renovate or maintain their current properties. So while full exterior repaints might dip slightly, the demand for power washing, cabinet refinishing, and deck maintenance goes up.
So they just shift their focus.
Exactly. Furthermore, the owner can actively pivot their marketing spend based on seasonality, pushing gutter services heavily in the fall, pivoting to commercial exterior painting in the spring, and driving interior residential jobs during the winter months.
It ensures the territory is yielding financial returns year-round, regardless of external market conditions.
Yes. It constantly circles back to maximizing efficiency.
Yeah, the heavy, centralized corporate structure creates efficiency on the administrative side, while the multi-service land and expand strategy creates efficiency on the local revenue-generating side. It really proves that this business model isn't actually about the physical act of painting, it's about deploying a highly optimized system.
And that is the core takeaway for any investor analyzing this space. We tend to overlook traditionally unsexy trades and home services. We dismiss them as blue-collar work while we hunt for glamorous tech investments.
Right, everyone wants to be the next Silicon Valley unicorn.
But when you take an industry that has historically suffered from fragmentation, poor communication, and unreliable guys in trucks, and you inject it with enterprise-scale corporate infrastructure, interactive consumer technology, and rigorous unit economics, I mean, the potential for market capture is staggering.
It really is.
These unsexy industries are quietly serving as some of the most scalable, resilient wealth-building vehicles available to modern professionals today.
It fundamentally challenges the narrative of what it takes to build substantial autonomous wealth in the modern economy. You don't necessarily need to invent a disruptive app or code a startup.
Not at all.
That you might just need a strategically engineered system, a 250-person corporate foundation backing your local operations, and a whole lot of paint to turn a local territory into a highly profitable enterprise.